Monetary Policy Committee, MPC, met on the 4th, 5th, and 6th of August to deliberate and decide on the policy repo rate. After a detailed assessment of the evolving macroeconomic and financial developments and the outlook, the MPC voted unanimously to keep the policy repo rate under the Liquidity Adjustment Facility, LAF, unchanged at 5.5%. Consequently, the standing deposit facility rate shall remain unchanged at 5.25%, and the marginal standing facility rate and the bank rate at 5.75%. The MPC also decided to continue with the neutral stance. CPI headline inflation declined for the 8th consecutive month to a 77-month low of 2.1% in June. This was driven primarily by a sharp decline in food inflation, led by improved agricultural activity and various supply-side measures. Food inflation recorded its first negative print since February 2019. It was negative 0.2% in June. Double-digit deflation in vegetables and pulses drove this contraction. High-frequency price indicators signal a continuation of the lower price momentum in fruit prices to July, the last month as well. Fuel group inflation moderated over 2 successive months to record 2.6% in June. Core inflation, on the other hand, which remained within a narrow range of 4.1 to 4.2% during February to May this year, increased slightly to 4.4% in June, partly driven by continued increase in gold prices. The inflation outlook for 2025-26 has become more benign than expected in June. Large favorable base effects combined with steady progress of the southwest monsoon, healthy kharif sowing, adequate reservoir levels, and comfortable buffer stocks of food grains have contributed to this moderation. CPI inflation, however, is likely to edge up above 4% in Q4 of this year and beyond, as unfavorable base effects and demand side factors from policy actions that we took a little while ago, a few months ago, come into play. Barring any major negative shock to input prices, core inflation is likely to remain moderately above 4% during the year. Weather-related shocks pose risks to inflation outlook. Considering all these factors, CPI inflation for the current year 2025-26 is now projected at 3.1%. This is down from 3.7% that we had earlier projected in June, with Q2 at 2.1%, Q3 at 3.1%, and Q4 at 4.4%. CPI inflation for Q1 next year, 2026-27, is projected at 4.9%. Southwest monsoon, lower inflation, rising capacity utilization, and congenial financial conditions continue to support domestic activity. The supportive monetary, regulatory, and fiscal policies, including robust government capital expenditure, should also boost demand. With sustained growth in construction and trade segments, the services sector is expected to remain buoyant in the coming months. Prospects of external demand, however, remain uncertain amidst ongoing tariff announcements and trade negotiations. The headwinds emanating from prolonged geopolitical tensions, though abated as I mentioned earlier, persisting global uncertainties, and volatility in global financial markets pose risks to the growth outlook. Taking all these factors into account, real GDP growth for 2025-26, the current year, is projected at 6.5%, our earlier projection, with Q1 at 6.5%, Q2 at 6.7%, Q3 at 6.6%, and Q4 at 6.3%. Real GDP growth for Q1 next year, 2026-27, is projected at 6.6%.